Good Monday morning or Monday afternoon, everybody. Hope everybody had a fantastic weekend. Please let me know if I am coming through loud and clear and you see me. Appreciate all of you being here today. Good morning, Guillermo. Awesome. Thank you, thank you. Market, trying to hang in there. It's down a little bit. SPOOs were down actually about 35 points earlier. They're down about 17 right now. Maybe taking a little break after last week's run. More record closes last week for the S&P, for the Dow. NASDAQ's getting there. All right. Hello, everybody. Good. You are coming through loud and clear. NVIDIA still making new all-time highs. Just absolutely, this stock won't stop right now. And you know what? We're looking through here, and what I see up on the board here is early in the day. Let me go here. Early in the day, there was a lot of buying in the Qs, in the triple Qs, and that flipped about a half an hour ago. So 2 hours ago, huge buyers in today's expiration 496 puts. And look at all of the volume here, guys. In all of these puts, and quite frankly on the call side as well, but earlier today, big buyers, and that flipped about 45 minutes ago. So is that when we saw, the market start to come back a little bit? Maybe. Who knows? Who knows who was on that? There's such huge volume in the Qs, but that was definitely something that I wanted to bring out and point out to everybody along with NVIDIA here. S&Ps are trying to squirrel their way back, rally their way back here. Banks are finally, I don't want to say getting hit, but giving back some of the run, some of the profits they've had over the last several weeks. We're seeing Goldman Sachs, even JP Morgan, Morgan Stanley. Those are all a little bit lower today. And one thing I'm really hoping for, quite frankly, is we've got these 88 strike puts here in Baidu that expire this week. I am so bearish on the Chinese markets, on the Chinese economy. Let's hope we can get some follow through right there. Okay, speaking of follow through and follow up, who remembers what we talked about on Friday and what we said we were going to talk about today? Who remembers that? Yes. Well, not call put parity. That's it. Exactly. Not bid ask parity, but call put parity. Similar. Very similar. So let me bring this up on the screen here. All right. Who can see this now? Put call parity and synthetic relationships. Can everybody see that on the screen? Excellent, excellent. So we are going to go into this equation here, okay? Because if we understand and we know this equation right here of a stock position equals a long call and a short put, boy, it makes things a lot less complicated. But what we have to understand first is that when we talk about put call parity, and we always talk about this, the amount of premium, okay, it's the amount of premium or extrinsic value has to be equivalent. So let me write this on here. The extrinsic value has to be equal between a call and a put. And if it's not equal, that's where arbitrage becomes a possibility. Okay, and when I say arbitrage, if a call is more expensive than a put, and again, not from the total price, but from the amount of extrinsic value, then there is an arbitrage opportunity based on this equation right here. Okay, so before we look into that equation, let's again take a look at some put-call parity and the amount of extrinsic value that is in an option. Okay, so let's take a look. I had actually chosen FedEx and was hoping that it was going to stay right here because it's right at the money. We've got a stock right at the money. So we can see FedEx here is trading, I wish I could get my marker, there we go. FedEx is trading right at 270. Okay, so if we isolate on these 270 call and put, we should see very, very equivalent pricing between the call and put, which we do. Now, it is, some of you should be saying this, it is a little bit off, right? The call is slightly higher than the put, and that is because of interest rates. When rates were down, several years ago, rates were down back at zero-ish or, 1%, 2%. Interest rates did not really play a factor at all when we were pricing options. But now that rates are significant, when I was trading on the floor, back in the 90s, we had rates 7, 8, 9% also, okay? But now that rates are significant, even though they are coming down, although they've gone up significantly since the Fed cut, okay, interest rates do play a factor. Does anybody know why? Does anybody know why interest rates do play a factor in pricing options? Give you guys a second to answer here. And if you don't know, that's fine too. You can just say, I don't know, because it's complicated. Nope. Gene, that's not it. Thomas, yes. Borrowing ability, very good, Thomas. Absolutely. Absolutely. So if you think of it, okay, if you're going to purchase stock, right? If you're going to buy stock, you're borrowing funds, basically from your clearing firm, your brokerage firm, okay, to buy that stock. So interest is a cost to an investor who borrows funds. And it's a benefit to investors who receive those funds and invest those funds from shorting stock. Okay, so the higher interest rates are, the more expensive call options will be, and the less expensive put options will be. So higher interest rates means call options are more expensive and put options are less expensive. Okay, so when we look at put-call parity right now, and we look at just the amount of premium or the amount of extrinsic value that's priced into an option, we do need to factor in interest rates. Okay, again, think of it this way. Okay, long stock, if you were just to take a stock position, not a long call position, but a stock position, that requires capital. Okay? So on the other side of this, if you were to buy a call option rather than buying stock, that amount of cost, that amount of interest that it would have cost you to borrow money to buy the stock has to be factored in to the price of the call. Does that make sense to everybody? Does that make sense? Okay, great. So that's number one. The other factor, which doesn't happen to every stock, interest rates do happen to every stock, but the other factor that affects call put parity, or the amount of premium, the amount of extrinsic value in a stock, not volatility, John, because what happens to a call is going to happen to a put. Vol is going to move the same. If it doesn't, that would provide a big arbitrage opportunity. But if a stock pays a dividend, okay, if a stock pays a dividend, that also can greatly affect the amount of premium in the price of a call or a put. The reason being, what happens when a company pays out on a dividend? What happens to the value of that company? Anybody? For instance, I think FedEx pays a dividend. FedEx pays a $1.38 dividend, but the next one is not until December 9th. Yeah, exactly. When they pay that dividend, they're giving away value in the company. They're giving away that cash. So the value of the company, the stock, goes down. Well, if we know for certain, right, if we know with 100% certainty that on some day, in this case for FedEx, it happens to be on December 9th, if we know for certain they are paying a dividend and that is going to decrease the value of the stock, what kind of option position would you want to be holding if you knew for sure the stock was going down? Yeah, you would either want to be long a put, own a put, or you would want to have sold calls, right? If you know the stock is going down. Either a long put or a short call. So that has to be, as Derek just said, that has to be already factored in to the price of an option. So the two things that can throw this put call parity out of alignment, but are already factored in, are interest rates and a dividend. Okay? The higher the interest rates, the more disparity there's going to be between a call and a put. The more expensive a call is going to be, or the less expensive a put is going to be. Okay? Now, let's get into this put call parity with something known as synthetic options. John, which Greek is affected by the dividend? None of them are. None of them are. The dividend is just well, I guess you could say the delta is. But if we know the price of the dividend, we know how much a stock is going to go down on a certain date. So that delta is already factored in. That delta is already factored in. Okay, who has ever heard of synthetic options or has seen this equation? And it's nothing more than a mathematical equation. Okay, it is nothing more than a mathematical equation. And you guys can write this down. You can, do what you want with it. I'll be happy to send this out to everybody when we're finished. If you just, shoot me an email that you want this, I'll be happy to do that. But let's break this down. Okay, let's break this mathematical equation down. Okay, what delta is a long stock position? If you owned 100 shares of stock, whatever stock it is, what delta would you have? Positive, but positive how much, Derek? Yeah, right? You'd have positive 100 delta. Okay, long stock's not 50, Bobby. Long stock is 100. Why is long stock 100? Think of it this way. You own 100 shares of Apple. If the stock goes up $1, how much did you make? You made $100. If the stock goes down $2, you lost $200, right? So it moves 1-to-1 with itself. That's why the 100 delta. Does that make sense? So let's look at how we can create synthetic positions from that equation. Whether we want to have a short stock position, awesome, Bobby, a long call, a short call, long put, short put, whatever it is. Let's take a look at an example here, guys. And let's, FedEx is moving a little bit away from strike. Let's see if Google, do we have 164 strikes? No, we don't. I wish we did. Looking for something right at the money here. Right at the money. DocuSign, okay. 72 strikes? Yep, DocuSign it is. Okay, guys, that's the great thing about doing this live in the markets. We get to see how things are actually moving. So DocuSign is trading 72. Okay, if you owned 100 shares, you would have plus 100 delta. Now, the delta on this call, okay, the delta on this call, I'm going to round this off, is 52. The delta on the put is 48. Does everybody see that? The at the money 72 strike option in DocuSign right now with the stock trading 72, call is 52 delta, the put is 48 delta. Excellent. Let's bring back our sheet here. Okay, let's bring this back. Okay, so we know that stock is plus 100 delta. Now, that is the equivalent of, well, we just said the call option had a 52 delta. Okay, so a long call means owning a call. That means I have positive 52 delta. Now, if I have a short put, selling the put, okay, that means I've sold a put. So I'm going to take my 52 delta from my long call, and we're going to sell, that's what this negative sign is. We're going to sell, what kind of delta does a put have, positive or negative? What is a put delta? Negative, exactly. So we're going to sell a negative 48 delta option. Okay, black line, a put delta is negative. Okay, but if we add this algebraic equation together, we get 100 equals 100. So there you go, Robert. So let's say you didn't want to trade stock for whatever reason, margin, or you just didn't want to, but you wanted to create a synthetic stock position. You would buy the call and sell the put. Same strike, same expiration. That will give you the equivalent position to a long stock. Does everybody see that? Does that make sense to everybody? Excellent. Now, let's look at some of the other combinations here. And again, all this is, guys, is an algebraic equation. That's all this is. Okay? Let's say we wanted to have a short stock position. Okay? And let me put up here again. Long stock equals long call and short put. Okay? Now, I don't want to scare anybody too much, going back to mathematics, back in grammar school, grade school, whatever. Okay? But how do we get this to equal short stock? Okay? How do we get a position to equal short stock? Okay? Mathematically, we have to get a negative stock position on the other side of the ledger. Okay? So what we have to do, mathematically, again, okay, and I know I'm taking you back to algebra here with, maybe not what everybody wants, but if we sell stock on this side, okay, and we sell stock on this side, okay, what that does is cancels out this side of the equation and just leaves us with this right now. Does everybody see that? Because if you have a long call, short put, and short stock position, you have a zero position. But we want to, the goal is to just get our short stock position only by itself. Only by itself. Ken, you can absolutely do that also. Okay, I wanted to take you through the long way first to do it, but absolutely you could do that as well. So we have to get that long call and short put to the other side. We got to cancel it out of the right side of the algebraic equation. So what do we have to do? We have to sell a call and buy a put. We have to do that the same thing on the other side of the equation. So what does that leave us here? That leaves us with short call, long put equals short stock. How do we verify that? Well, let's use the same deltas that we did before. Remember, the call was 52 delta, and the put is 48 delta. Okay, is everybody with me here? All we're doing is verifying that from a Greek standpoint, that this option position is equivalent. Okay, so if we have a short call, that's minus 52. If we own a put, if we have a long put, that's minus 48. That gives us minus 100 delta. What is the delta of a short stock position? Minus 100. You would have an equivalent position to a short stock position if you sold the call, bought the put, same strike, same expiration. Does that make sense to everyone? Okay, great. Let's do one more here, okay? We just did a short stock position. Let's do a long put position. Okay, let's do a long put position. We have stock equals call minus put. Okay, we want to get this to a positive put. Okay, so let's cancel out the puts on this side. And if we do that, we have to add a put to this side. Okay, so right now we have a long put plus stock equals a long call. Okay, well, we want to isolate that long put. We just want to have that long put by itself. So what do? Well, now we've got to sell stock on each side. Okay, so if we do that, what does that leave us with? It leaves us with that. And I know this is pretty crude. Long put equals call minus stock. Let's prove that out mathematically. What was the delta to our long put? Does anybody remember that? Guillermo, you are spot on. Nicely done, man. Nicely done. Our long put was negative 48 delta. Okay, well, on this side of the equation, as Guillermo said, we have our long call, which is positive 52. But then if we subtract the short stock, negative 48. Does everybody see how that works? Now, this is the mathematical equation from a delta standpoint. The way that put-call parity comes into play is if one option from an extrinsic value, a premium level, is mispriced versus the other option, the put versus the call. Because you could then see, not only from a delta perspective, do the deltas have to be equivalent on both sides, the premium levels have to be equivalent on both sides. Okay? Obviously disregarding either interest rates or dividends. If they weren't the same, then you would have an advantage on one side of the ledger or the other. Now, it doesn't happen very often, realistically, in the marketplace. Sometimes, though, when we get really, really volatile, or if a stock, is really volatile and halts trading and gets back on and halts trading again, sometimes you can capture some of that aberration, some of that difference in that premium, in that put-call parity. But by understanding the synthetic equations also, guys, that can allow you to take advantage of some extra premium perhaps in the marketplace. Okay, does everybody understand that? Does everybody understand that? And in fact, what I'm going to do is, while we're doing the wheel, and I don't want anybody to sign off yet, I'm going to, can you please turn this into a bit.ly or a link to post? I'm going to post up in the live stream here a link to what I just had up on the screen there. So Let me get that here, and then we will go to the wheel while they're doing that. And anybody don't go away. Let me just make sure that someone is going to do that, please. Can you set up an scanner? I don't know, Guillermo. That's a great question. I would bet probably not. Perhaps, but my guess is any scanner that you and I would have, that we would potentially have, the algos out there would be light years ahead of us. And in trading, light years literally means nanosecond. At Danny, can we do that? All right, let's get to the wheel. I'm going to try and get this link, and if not, anybody that wants it, I will post it up here tomorrow, or you can shoot me an email, and I'm happy to send that to you. Okay, it's a new, oh man, the wheel is filled today. Woo! Hopefully that means we're getting more and more people tuning in here. That would be awesome. That would be awesome. All right. I gotta get a better drum roll. Hang on. I can't pound the desk anymore. Let me get a better drum roll. There we go. All right. The wheel has spun. Who is it going to be today? John Berg. John Berg. Nicely done. I'm typing in here. If you want a copy of the synthetic sheet, please email me at prosperswag@prospertrading.com. John, you also please email me there. Let me know size, mailing address, all that good stuff, all right? And I will, again, I will post up tomorrow the link to this, but if you email me, I'll be happy to email it to you. Okay? Really hope this was helpful, everybody. And thank you. We will see everybody tomorrow. Have a good one, everybody.